With the income tax return filing season on, taxpayers are searching for ways to minimize their tax liability. And with the investment appreciation becoming increasingly common, it has become imperative to understand capital gains and how one can reduce their tax liability associated with it. Hence, to claim exemption and save taxes, taxpayers must know the ins and outs of Section 54 and Section 54F of the Income Tax Act, which deal with capital gains. Hello everyone, I'm Hemant Abhishek and welcome to a brand new edition of Paisa Wasool, where today we'll talk about how taxpayers can save tax on sale of long-term assets and residential property. Who all are eligible to claim exemptions? So all those who have sold or transferred an asset and reinvested the proceeds in a new residential property can avail tax benefits under Section 54F. The important point to remember here is that the amount received should either be reinvested 1 year before the sale of the property, or used to purchase property within 2 years of sale, or used to construct one within 3 years of the sale. The exemption applies to long-term capital assets that are held for over 24 months. And in case of real estate, the holding period must be 36 months or more. Provisions of Section 54 are applicable to the sale of residential property, while Section 54F applies to all capital assets other than residential property, such as gold, equity shares, and non-residential property. After sale, the amount exempted under Section 54 will be the lower of the capital gain or the investment made in the new property. Let's understand the capital gains tax exemption better with the help of an example. So supposing you purchased a residential property for Rs 30 lakh and sold it for 80 lakh, meaning you made a long-term capital gain of Rs 50 lakh. So if you purchase a new property for Rs 40 lakh, the remaining 10 lakh would be taxable under the applicable capital gains tax rate. Or if you bought gold worth Rs 20 lakh and sold it for Rs 90 lakh, then your profit and the long-term capital gains is Rs 70 lakh. And as per Section 54F, you can claim tax exemption if you use the entire proceeds of the sale, that is Rs 90 lakh in this case, to purchase a residential property within the specified time frame. If you are unable to use the proceeds towards reinvestment within the same financial year, then the proceeds from the sale must be kept in a capital gains account scheme to claim tax benefits. So what are the rules pertaining to residential property? An important condition for availing the exemption is that at the time of the sale of the original asset, the taxpayer should not own more than one residential house other than the new property. In this year's budget, the Finance Minister announced a deduction cap of Rs 10 crore for capital gains on investments in new residential properties. To summarize, Section 54 focuses on long-term capital gains derived from the sale of a residential property, whereas Section 54F caters to long-term capital gains obtained from the sale of any asset other than a residential property. If these gains are reinvested in a new residential property, then tax benefits can be claimed. And the exemption amount is determined by the lower value between the capital gains or the investment made in the new property. It is important to know that the exemptions on capital gains tax can be claimed by the individual taxpayer as well as the Hindu undivided family. That's all for this edition. We will return in the next video with some more wealth and investment tips and tax saving tricks. Till then, goodbye, take care, and keep wasooling paisa, because if it's not value for money, it's not worth it.